Are you ready to transform your investment strategy and secure your financial future? Imagine this. You invest $100,000 today, and in 30 years, that investment grows to nearly $500,000, $432,194 to be exact, all while you sleep soundly at night knowing your money is working hard for you. In this video, we're unveiling 5 incredible bond ETFs that offer eye-popping dividends, with yields soaring up to 5.4% as of July of 2024. These ETFs aren't just about numbers, they're about building a rock-solid financial foundation. With billions of dollars under management and a blend of government and corporate bonds, they promise stability and consistent returns. Whether you're a seasoned pro or a curious beginner, stick around to learn how these high-yield bond ETFs can supercharge your portfolio and deliver handsome dividends without the gut-wrenching volatility of the stock market. Ready to discover how your $100,000 can grow into a financial fortress? Let's dive in. In this video, we're diving deep into the world of high-yield bond ETFs that can transform your investment strategy. We're talking about 5 top-performing ETFs that not only offer impressive dividends but also promise stability and growth. You'll learn about their standout annual yields, with some reaching as high as 5.4%, making them exceptional in today's market. These ETFs can manage billions in assets, ensuring your investments are in safe hands. We'll break down their incredibly low expense ratios, such as going as low as 0.03%, so you can maximize your returns. Plus, we'll reveal how these ETFs provide a balanced exposure to government and corporate bonds, giving your portfolio a robust and diversified edge. Most excitingly, let's talk dividends. Imagine investing $100,000 today and, based on current yields, receiving around $23,837 in dividends after 30 years. That's the kind of financial boost we're discussing here. By the end of this video, you'll understand why these bond ETFs are the perfect choice for generating steady income and achieving long-term financial security. Stay with us to discover how to leverage these powerful investment tools and build a portfolio that prospers. Let's get started on this journey to financial success. Vanguard Total Bond Market ETF. Harry, an investor for a stable and diversified bond investment, decided to invest in the Vanguard Total Bond Market ETF. This ETF is renowned for its broad exposure to the US bond market, managing over $108.6 billion in assets with an SEC yield of 4.7% as of July of 2024 and an expense ratio of just 0.03%. BND offers a compelling combination of income and low costs. The Vanguard Total Bond Market ETF holds over $11,000 investment-grade bonds, including US Treasuries, government-related and corporate bonds, mortgage-backed securities, and asset-backed securities. About 50% of its assets are in government bonds, ensuring a stable foundation, while another 27% are in corporate debt from the high credit quality companies like Apple, Microsoft, and Johnson & Johnson. This diversification reduces the risk of any single bond defaulting and impacting Harry's investment. Harry invested $100,000 in BND. If we consider the compounded annual growth rate of the bond market historically, which hovers around 3 to 4%, Harry can expect his investment to grow steadily. Over 1 year, Harry's investment would generate around $4,700 in dividends, and after 5 years, assuming a CAGR of 3.5%, his investment would grow to approximately $118,150, providing annual dividends of around $5,552. Holding BND for 10 years would result in Harry's investment growing to roughly $140,388, with annual dividends of $6,597. After 20 years, his investment would appreciate to about $197,856, yielding annual dividends of $9,298. Finally, after 30 years, Harry's initial $100,000 could grow to approximately $279,338, delivering annual dividends of $13,000, assuming a consistent yield. The payout ratio for BND remains attractive as it distributes almost all of its income as dividends, making it an excellent choice for income-focused investors like Harry. The fund's expense ratio of 0.03% ensures that Harry's returns are not significantly eroded by fees, allowing more of the income to reach his pocket. Vanguard, the investment company behind BND, is one of the most respected names in the industry, known for its investor-friendly approach and low-cost funds. Vanguard's commitment to providing quality investment options ensures that BND remains a top choice for bond investors. By holding BND, Harry not only benefits from the immediate income generated by the dividends, but also from the long-term growth potential of the bond market. This makes BND a cornerstone of Harry's investment portfolio, providing a reliable income stream and preserving capital over the long term. iShares 20+ Year Treasury Bond ETF. Harry, always on the lookout for stable and high-yield investments, decided to invest in the iShares 20+ Treasury Bond. This ETF focuses exclusively on US Treasury bonds with maturities of 20 years or more, providing a high level of security backed by the US government. As of July of 2024, TLT manages $50.2 billion in assets with a current SEC yield of 4.5% and an expense ratio of 0.15%. The iShares 20+ Year Treasury Bond ETF is designed to track the investment results of the index composed of U.S. Treasury bonds, with the remaining maturities greater than 20 years. These long-duration bonds are sensitive to interest rate change, but offer significant yield potential. For Harry, this means a stable income from a highly secure source, albeit with some sensitivity to interest rate fluctuations. Harry invested $100,000 in TLT. Given the current yield of 4.5%, his initial investment would generate approximately $4,500 in dividends over the first year. Assuming an average compounded annual growth rate of 4% for long-term Treasury bonds, Harry's investment would appreciate over time despite the inherent interest rate risk. After 5 years, Harry's $100,000 investment would grow to about $121,665, providing annual dividends of $5,475. Holding TLT for 10 years, the investment would grow to approximately $148,024, with annual dividends of $6,651. After 20 years, his investment would be worth around $219,112, yielding annual dividends of $9,860. Finally, after 30 years, Harry's initial investment could grow to an impressive $324,339, delivering annual dividends of $14,595, assuming consistent growth and yield rates. The payout ratio for TLT is inherently tied to the income generated by the U.S. Treasury bonds it holds, ensuring a reliable stream of income for investors like Harry. The expense ratio of 0.15% is slightly higher compared to some other bond ETFs, but remains reasonable given the security and the potential returns offered by long-term U.S. Treasury bonds. Managed by iShares, a subsidiary of BlackRock, TLT benefits from the expertise and scale of one of the world's largest asset managers. BlackRock's reputation for robust risk management and extensive research supports the reliability and performance of TLT, making it a trustworthy option for income-focused investors. By holding TLT, Harry not only secures a steady income stream from one of the fastest and safest asset classes, but also positions himself to benefit from potential capital appreciation over the long term. This makes TLT a prudent choice for investors seeking stability and attractive yields, especially in uncertain economic times. iShares iBoxx Investment Grade Corporate Bond ETF, LQD. Harry, aiming for a blend of higher yields and safety, decided to invest in the iShares iBoxx Investment Grade Corporate Bond ETF. This ETF is renowned for its focus on high-quality corporate bonds, specifically those with credit ratings of BBB or higher. As of July 2024, LQD manages $29.5 billion assets and offers a substantial SEC yield of 5.4% with an expense ratio of 0.14%. The iShares iBoxx Investment Grade Corporate Bond ETF holds bonds from leading corporations, providing Harry with exposure to debt securities from companies like Apple, Microsoft, and JP Morgan Chase. This diversification across various sectors reduces the risk associated with any single issuer defaulting, ensuring a balanced and stable investment. The ETF's focus on investment-grade bonds means that it includes bonds with lower default risk, thus maintaining a high level of security for investors. Harry invested $100,000 in LQD, assuming a compounded annual growth rate of 5%, reflective on historical performance for investment-grade corporate bonds. Harry's investment would not only generate significant income, but also appreciate in value over time. In the first year, Harry would receive approximately $5,400 in dividends. After 5 years, with reinvested dividends and assuming a consistent CAGR, his investment would grow to about $127,628, providing an annual dividend of around $6,891. Holding LQD for even 10 years, his investment would be worth approximately $162,889, yielding an annual dividend of $8,798. After 20 years, the investment would depreciate to roughly $265,330, with annual dividends of $14,377. Finally, after 30 years, Harry's initial $100,000 could grow to approximately $432,194, delivering annual dividends of around $23,837. The payout ratio for LQD is attractive as it distributes almost all of its income as dividends, making it an excellent choice for income-focused investors like Harry. The expense ratio of 0.14% ensures that Harry's returns are not significantly eroded by fees, allowing more of the income to reach his pocket. Managed by iShares, a part of BlackRock, LQD benefits from the extensive expertise and resources of one of the world's leading asset managers. BlackRock's commitment to robust risk management and thorough market analysis supports the reliability and performance of LQD, providing Harry with confidence in his investment choice. By holding LQD, Harry gains access to a high-yield, low-risk investment that provides a steady stream of income and potential for capital appreciation. This makes LQD a solid addition to Harry's investment portfolio, aligning with his goals of securing stable long-term returns. Vanguard Total International Bond ETF, BNDX. Harry, seeking to diversify his bond holdings from internationally doing so, decided to invest in the Vanguard Total International Bond ETF. This ETF offers a unique opportunity by providing exposure to high-quality investment-grade bonds from around the globe, excluding the United States. As of July 2024, BNDX manages $55.9 billion in assets and offers a current SEC yield of 3.3% with an expense ratio of just 0.7%. The Vanguard Total International Bond ETF holds a diverse array of bonds from various countries, ensuring geographical diversification that reduces the risk associated with any single economy. About 57% of BNDX assets are in Europe, with significant holdings in bonds from countries like Germany, France, and the United Kingdom. Another 20% of its assets are in the Asia-Pacific region, including Japan and Australia. Additionally, BNDX includes approximately 7% in emerging market debt, offering potential for higher returns, albeit with slightly higher risk. Harry invested $100,000 in BNDX, assuming a compounded annual growth rate of 3%, which is reflective of historical performance. For international investment-grade bonds, Harry's investment would provide steady income and moderate growth over time. In the first year, Harry would receive approximately $3,300 in dividends. After 5 years with reinvested dividends and assuming a consistency AGR, his investment would grow to about $115,927, providing annual dividends of around $3,826. Holding BNDX for 10 years, his investment would be worth approximately $134,392, yielding annual dividends of $4,435. After 20 years, the investment would appreciate to roughly $180,611, with annual dividends of $5,960. Finally, after 30 years, Harry's initial $100,000 could grow to approximately $242,742, delivering an annual dividend of around $8,011. The payout ratio for BNDX is appealing as it distributes most of its income as dividends, making it a reliable choice for income-focused investors like Harry. The low expense ratio of 0.07% ensures that Harry's returns are maximized by keeping costs minimal, allowing more income to be retained. Vanguard, the investment company behind BNDX, is globally renowned for its commitment to low-cost, high-quality investment options. Vanguard's extensive experience and dedication to investor satisfaction make BNDX a trustworthy and efficient choice for international bond exposure. By holding BNDX, Harry not only diversifies his bond portfolio geographically, but also secures a stable and consistent income stream from various high-quality international bonds. This strategic investment in BNDX aligns perfectly with Harry's goals of achieving long-term financial stability and growth. Schwab U.S. Aggregate Bond ETF, SCHC. Harry, aiming for a comprehensive exposure to the U.S. bond market, decided to invest in the Schwab U.S. Aggregate Bond ETF. This ETF is designed to track the performance of the Bloomberg Barclays U.S. Aggregate Bond Index, which includes a broad range of investment-grade bonds. As of July of 2024, SCHZ manages $8.2 billion in assets and offers a current SEC yield of 4.2% with a very low expense ratio of 0.04%. The Schwab U.S. Aggregate Bond ETF provides investors with exposure to U.S. Treasuries, government-related and corporate bonds, mortgage-backed securities, and asset-backed securities. This diverse mix of bonds ensures a balanced risk profile while aiming to provide steady income. Major holdings include U.S. Treasury bonds, high credit quality corporate bonds from companies like Apple, Microsoft, and Berkshire Hathaway, as well as government-backed mortgage securities. Harry invested $100,000 in SCHC, assuming a compounded annual growth rate of 3.5% reflective of its historical performance of the U.S. aggregate bond market. Harry's investment would provide consistent income and moderate growth over time. In the first year, Harry would receive approximately $4,200 in dividends. After 5 years with reinvested dividends and assuming a consistency AGR, his investment could grow to about $118,875, providing annual dividends of around $4,994. Holding SCHZ for 10 years, his investment would be worth approximately $140,480, yielding annual dividends of $5,897. After 20 years, the investment would appreciate to roughly $197,327, with annual dividends of $8,289. Finally, after 30 years, Harry's initial $100,000 could grow to approximately $277,220, delivering annual dividends of around $11,645. The payout ratio for SCHZ is attractive as it distributes most of its income as dividends, making it an excellent choice for income-focused investors like Harry. Extremely low expense ratio of 0.04% ensures that Harry's returns are not significantly diminished by fees, maximizing his income potential. Managed by Charles Schwab, one of the most respected names in the financial services industry, SCHZ benefits from the company's commitment to low-cost, high-quality investment products. Schwab's extensive resources and expertise in managing a diverse portfolio of bonds support the reliability and performance of SCHZ, providing Harry with confidence in his investment. By holding SCHZ, Harry gains access to a diversified, stable bond portfolio that offers a steady income stream and potential for capital appreciation. This makes SCHZ a solid addition to Harry's investment strategy, aligning perfectly with his goals of achieving long-term financial stability and growth. Risk and volatility analysis. Vanguard Tool Bond Market ETF. Harry, understanding the importance of risk management, considered the risk and volatility of the Vanguard Total Bond Market ETF. Historically, VND has shown low to moderate volatility due to its diversified portfolio, $11,000 investment-grade bonds. The fund's large dedication and allocation to U.S. government and high-quality corporate bonds helps mitigate risk. However, BND is not immune to interest rate risk. For example, during the interest rate hike cycle in 2013, BND experienced a loss of approximately 2.15%. Similarly, in 2018, when the Federal Reserve raised rates 4 times, BND saw a decline of around 1.7%. The ETF sensitivity to changes in interest rates can result in short-term volatility, although the long-term stability of government and investment-grade bonds generally helps cushion significant losses. iShares 20+ Year Treasury Bond ETF. Harry also evaluated the risk and volatility associated with the iShares 20+ Year Treasury Bond ETF, TLT. TLT is known for its high interest rate sensitivity due to its focus on long-duration U.S. Treasury bonds. This sensitivity means that TLT can experience significant volatility in response to changes in interest rates. For instance, in 2013, TLT saw a significant decline of about 13.9% due to the Federal Reserve's announcement of tapering bond buying program. Similarly, from 2015 to 2016, TLT experienced a decline of approximately 7.5% as the Federal Reserve raised interest rates. Despite the safety of U.S. Treasury bonds, the long duration makes TLT more volatile compared to the shorter-term bond funds. Investors should be prepared for significant fluctuations, especially during periods of changing interest rate policies. iShares iBox Dollar Investment Grade Corporate Bond ETF, LQD. When looking at the iShares Box Investment Grade Corporate Bond ETF, Harry noted its moderate risk and volatility profile. LQD's focus on high-quality corporate bonds generally provides a good balance between yield and risk. However, the ETF can be susceptible to credit risk and interest rate risk. During the 2008 financial crisis, LQD experienced a significant decline of about 17.3% as corporate bond spreads widened dramatically. Additionally, periods of rising interest rates have also impacted LQD's performance. In 2013, LQD saw a loss of approximately 4.7%, and in 2018, it experienced a decline of around 3.3%. Despite these risks, the overall credit quality of the holdings in LQD helps mitigate some of the volatility, making it a stable choice for income-focused investors. Vanguard Total International Bond ETF, VNDX. Harry also considered the risk and volatility of the Vanguard Total International Bond ETF. This ETF provides exposure to international investment-grade bonds, which introduces currency risk and geopolitical risk, in addition to interest rate risk. For instance, during the European debt crisis between 2010 and 2012, BNDX experienced heightened volatility and saw declines of around 3 to 4% in some quarters. In 2018, due to global interest rate increases and currency fluctuations, BNDX experienced a decline of approximately 2.8%. However, Vanguard's currency holding and hedging strategies helped to mitigate some of the risk, providing more stable returns compared to unhedged international bond funds. Schwab US Aggregate Bond ETF, SCHC. Finally, Harry analyzed the risk and volatility of the Schwab US Aggregate Bond ETF, SCHC, tracking the Bloomberg Barclays US Aggregate Bond Index, which includes a broad mix of U.S. Treasuries, government-related and corporate bonds, mortgage-backed securities, and asset-backed securities. The diverse nature of SCHC's holdings generally results in lower volatility compared to more specialized bond funds. However, it is still subject to interest rate risk and credit risk. During the 2008 financial crisis, SCHC experienced a decline of about 5.6% in 2013. During the Federal Reserve's taper tantrum, SCHC saw a decline of approximately 2%. Despite these periods of volatility, the high-quality nature of its bond holdings provides a cushion against severe market downturns, making it a reliable choice for long-term investors. Investing in these top-performing bond ETFs can provide you with a steady income and long-term growth. By diversifying your portfolio with a mix of government and corporate bonds, you can mitigate risk and enjoy reliable returns. If you're ready to enhance your investment strategy and secure your financial future, consider adding these bond ETFs to your portfolio. Make sure to do your own research and consult with a financial advisor to find the best fit for your goals. Don't forget to like this video, subscribe to our channel, and hit the bell icon for more insightful investment tips and strategies. Happy investing!